Good afternoon, ladies and gentlemen. A very warm welcome to you on Business Today Television and our ongoing series of market experts. We are now joined by perhaps the happiest or the second happiest man on Dalal Street, Mr. Dinshaw Irani. He's the CEO of Helios Capital, and the happiest or the second happiest man, depending upon how you rank it, is his partner in investments, Mr. Sameer Arora. A very warm welcome to you, Irani Saab, and as usual, in this kind of a pain and mayhem that's happening on Dalal Street, the most genuine smile that one can ever find is on Mr. Irani's lips. A very warm welcome to you, Dinshaw, and what a pleasure to host you.
Thank you, Shailendra. So thank you for having me on your show, and always a pleasure to be on your show. And a very good afternoon to you, your team, and the viewers.
चलिए, on this wonderful note post Holi, let us now examine how the markets are placed, Dinshaw ji. Terrible times, if I may say so. A lot of pain across the board. Even funds such as yours have focused on holding cash at this point of time. Elaborate for our viewers, how do you feel at the moment? Is this a space to be active buying, or is this a space to be passively waiting for the pain to last?
First, let me address the cash bit. So sometime in Feb, we realized that IT, actually AI was a major disruptor for IT. In fact, we realized this over a period of time after interacting with a few corporates, IT corporates, and we realized that, and since disruption is a major factor for rejection for us, we decided to exit IT in toto, except one stock. We totally exited IT, and fortunately, I mean, obviously the cash was created at that point in time. We did exit a few of the platform companies too along the way. And the cash that got created, we were not in a rush to invest because we realized that the markets were correcting. So by the end of the month, you saw a lot of cash in our books, around 21, 22 odd percent. But today, if you ask me, I think we've been fairly progressive. We've been almost, I mean, more than 50% of the cash we've invested back in the market. And we're looking out for opportunities. Having said that, Shailendra, the thing is that I mean, frankly, I mean, nobody can put a finger on this, whether it's the top or the bottom of the market. But our heart tells us that we're somewhere close to the bottom. But the head tells us to, be a bit more cautious in that view. So that's why we're being very cautious in our view and selectively be picking up stocks where we believe the valuations have come into our comfort zone. Ultimately, the market's going to respect valuations, and obviously the valuations have to be supported by the growth in earnings, and that's what we're looking out for, and that's where we're trying to redeploy the money as such.
Okay, let me just confirm, let me just inform our viewers. At the moment, Helios set of funds manages about 3,400 crores as AUM. The biggest fund is the FlexiCap fund, which has a corpus of 2,560 crores. At the moment, Mr. Irani is at about 8 to 9% cash of 3,400 crore rupees. In February, this was 21 to 20%. So about 50% of cash has been deployed, and he has exited counters like please hold your breath, HCL Technologies, TCS, Infosys is what I can make out. Then within the platform companies, you've exited Swiggy, you have exited PB Fintech, and you have also exited Coforge. This is the latest data that we have. This cash has now been deployed. So from your own side, Mr. Irani, where has this 50% cash gone?
So mostly it has gone into finance. I mean, as in the banks rather. We've been very selective there, and I think given the way we are placed today, banks are definitely a screaming buy as of now. I mean, as in look at the valuations of these guys, they're fairly reasonably valued. And the fact that they've not at all performed in this whole rally that the market went through till September of last year itself shows you that they're ripe for this thing for a not a rally, but at least to support the markets. In fact, if you look at the heavyweights within the index, the two banks that are the heavyweights, they've been fairly resilient. They have, in fact, gained, if anything. And our belief is that the private sector banks, again, let's not paint the whole sector with the same brush, because there are certain banks within the private sector which we will be avoiding. We are very selective in our picks in the private sector again, and we've been picking those up. Obviously, we've looked at the domestic capex plays, domestic energy plays, and stuff like that, and we've been selectively picking on those also as such. So these are a few sectors where we are fairly been selective.
Okay. The two heaviest weighted banks in the index, whether it's the Nifty or the Bank Nifty, are HDFC Bank and ICICI Bank. From the portfolio that I have, it seems that you've raised stake in both of them. And one dramatic change or one dramatic positive change is Kotak Mahindra Bank, where a lot of money has flowed into. Am I correct here, sir?
Yes, you are, because as I said that we're now looking at quality and quality at a price. And frankly, I mean, Kotak, with all the regulatory actions that were undertaken earlier, had suffered a bit, and things got cleared up along the way. And I think the way we looked at it was that even the worst of times, the NPAs were totally under control. So you can imagine the quality of the assets, and that's why we picked up a Kotak. And obviously, the valuations were fairly good.
Absolutely. I'll request the PCI to fire a longer term chart of Kotak Mahindra Bank. This is one stock that has gone nowhere over the last 5 years or so, mainly on, there could be many reasons, let's not get into them. The latest one was that they had a brush up with RBI, and those problems have been sorted. They were related to the credit card business and to the business of getting customers online. That has been solved, and Mr. Irani has duly put in a large chunk of money there. You also were a very, very big holder of HPCL, Dinshawji. I remember talking about 8-9 months ago when HPCL was amongst the top 5 holdings of the Flexi Cap fund. You exited and then you are back again.
Yeah, actually, we are back again, and frankly, when the call is again the same, we did enter earlier because we were looking at value unlocking, we were looking at benign crude prices, and we exited because we realized the valuations got stretched, and of late the valuations have come back into our comfort zone. The story remains the same. The crude prices are benign thanks to what's happening in the US. I mean, if anything, they've corrected a bit. And as a result, the crude margins have moved up. The refining margins, rather, have moved up, as can be seen from the Singapore graph as such. So that's why we came back in the in that particular stock. And frankly, I mean, valuations, as I said, have been fairly appealing now once again. So.
Okay. Dinshawji, according to you, what are the 3 or 4 main pain points that you feel in the market at this point of time? You've obviously mentioned that you're looking for earnings growth, but what is in the background which you say, you know, that our head tells us to be cautious, but our heart tells us that we are somewhere near the bottom?
So why the heart tells us we are near the bottom is because the way the valuations have corrected so sharply. In fact, in September of last year, we were probably our premium as an MSCI India premium to MSCI World Index had shot up to a very phenomenal, I think 25, 26% odd, which was a lifetime high. And as of Feb end, I think it came down to low single digits, some 3 or 4% or so. So it's obvious that the world has moved forward. We didn't.
Yes.
We in fact corrected a bit. And in fact, this is the first time that we've seen that India, and after a fairly long time, that is, when India has corrected on its own, and I think the main cause was obviously the valuations and the fact that the earnings growth had vanished. Obviously, the way the liquidity was sucked out from the system by the regulator, I think that impacted demand to a great extent. And frankly, I mean, as I said, the heart tells us this, because now that the liquidity is getting infused again, you'll see probably demand uptick happening once again. I'm talking about consumer demand right now, happening once again. And as a result, the fundamentals too will also improve, which got deteriorated as such. In fact, September was the worst quarter with a negative growth. December did see some growth, but again, it was fairly tepid. March, I don't see to be any different actually, Sharendra, because I also expect March to be a single digit kind of growth, but there will be growth. But once you go into the June and September quarter once again, the
Okay.
base becomes very appealing because the growth rate tanked off from June onwards, and as a result, the base becomes good for your comparison. So YOY will start looking good. As I said, FIs will definitely be looking at India once again because obviously the rupee has corrected quite a bit. Their major concern was the rupee when they started moving out. Obviously, the trigger points were probably the valuations and the earnings
Absolutely.
growth. But with the rupee collapsing the way it did, I think someone sitting somewhere, a global strategist will start looking at India and saying, look, we've sold enough out here. Let's
Yes.
start moving some money back in. So that's what telling us. But as I said, our head tells us to stay away because the way the US is behaving, I mean, the global tariff war that is going to commence, I think that is what is the only concern area. Had that not been a question, I think we would have gone ahead and probably deployed all the cash that we had. But today we are being a bit cautious there. We're being very selective. And let's see what happens on 2nd or 3rd of April when things become a bit more clearer of how they're going to approach this. So.
Okay. Two developments, Mr. Irani, after we met. One is, of course, the RBI injecting a lot of fresh liquidity into the system, a bit of a cut in the CRR, and then the government coming up with this tax bonanza of about 1 lakh crore rupees each year to the middle class. How has your portfolio reacted to these two developments? Where has the money gone in? One, I believe, is the banks.
Yeah, so basically, as I said, liquidity was a big constraint for the banking system because they had stopped lending, the growth wasn't happening on the asset book as such, so that way. But the fact is that with this liquidity infusion, that has eased out. Obviously, interest rates coming off is a big positive. Our feel is that maybe the RBI will, looking at the inflation print, RBI may come back with another rate cut even before the next MPC meet as such. But let's keep our fingers crossed on that. And obviously, I mean, with the infusion of so much of money by the way, I think the budget was a big shocker in the sense, a positive shock that is, because nobody expected the slabs to move from 7 to 12 odd lakhs, 12.75 in fact, to be more precise. But the fact was that that was what was needed by the system. You needed to shock the system into believing that, look, we are there to support you. And that's why I think that action from the government, the fact is that 1 lakh crore standalone looks not that exciting. But if one applies the velocity of money factor of
Yes.
5, then it starts looking really good. I mean, because you're talking about what? Probably a 4.7 kind of a leap on the consumption GDP
Yes.
as such, probably 2.3% on the overall GDP numbers, which is really exciting. And I think that is what was needed. And as I said, that we are just hoping that consumers start coming back to the market. Obviously, we re-twisted our portfolio also to that extent because we bought some consumption names. We got some healthcare names as such in our portfolio. Yeah, and that's it. So.
And of course, the consumption name is right there in front of me, but it's better that it comes via you rather than me. So the two names, maybe you can, one you've raised your stake, one you've added.
Yeah, so basically the fact is that we wanted to be there in the portfolio. I won't take names. You are at the liberty to take names, but I'm not. So the whole idea was that. Sorry.
So, okay, Mr. Irani has added Bajaj Auto as far as the February's latest portfolio is concerned and upped his stake in Zomato while removing Swiggy altogether. So, one of the platform stocks that he exited is Swiggy, but Zomato I think is 1, 2, 3, the third largest holding that you have, and you've taken this opportunity in the market where the stock price has dipped to add to this. Would you care to explain the logic behind Bajaj Auto, sir?
So Bajaj Auto was basically the fact that if the way the SOPs have been given out by the government, if the consumer comes back to the market, obviously the first thing that he'll look at is the entry level two-wheelers and stuff like that, and that's what excited us. And frankly, I mean, looking at the way Bajaj has been handling itself in history, also it's fairly resilient. In fact, rather half the turnover comes from exports, and that market looks pretty insulated for them. And given the way the rupee has collapsed, obviously it's very big positive for the exporter also as such. So that was one point. I'm sure your next question is why up the stake in Zomato and get out of Swiggy
Yes.
because they're the same as such. I think what we did realize was that the way Zomato handled competition was far better than what Swiggy did because Zomato basically they realized that to manage the competition, it can't be a knee jerk fight discounts with discounts kind of a strategy. You have to have your backbone straight. You've got to strengthen that. So that's why they preponed all their capexes. They preponed the 2 year capex. They crunched it into like 9 months practically as such. So that way, and that's what they're trying to do. Basically, strengthen the stores, get the logistics right, and stuff like that. So I think that's what we liked, and that's why he said, okay, we are bullish on the quick commerce food delivery business. So might as well be with the leader as such, and that's why we went with Zomato and not Swiggy.
Fair point. And of course, the NBFC space, as you rightly point out, is again the liquidity play. You've increased your presence both in Bajaj Finance and Shriram Finance.
Again, consumption plays. I mean, Bajaj Finance obviously is the largest consumer financing company as such, and Shriram Finance obviously both. It's a mix of even say CVs, commercial vehicles and stuff like that. That's what we liked about it. I think logistics is a way forward. If consumption is going to pick up, logistics has to pick up, and that's what it's a two-way play for us. And that's why, as I said, that we anyway bullish on BFSI, so might as well pick these names. So
Okay. So essentially, the hard work that has gone in the last 20-25 days has been increasing stakes in top flight private sector banks, then maybe adding a fillip on NBFCs, and third, adding a consumption theme given what the government has done. At the same time, you've subtracted IT completely. So that's the broad 20-day work that Helios did. And reduced
you
cash.
summed it up well. You summed it up well.
Correct. Acha. Now, sir, tell me, what about gold? We have $3,000 per ounce on the charts. You are worried about Trump. There is a tariff plus a currency war in the offing. And as usual, the Indian housewife has trounced fund managers.
Very true. In fact, today I had a analyst who was presenting on some of his consumer names, and he said that my wife cashed out on the Titan that deal that they have, the cash deal that they have, and he said,
Yes.
I think she's done a better job than me in investing at least. But anyway, coming to gold per se, I think the fact is that gold is mainly a hedge against uncertainty, against inflation. And what US is going through today, I mean, as in if President Trump gets his way and there's tariff war on, there's a lot of uncertainty. Inflation is for sure. So I think as long as he continues to trumpet that kind of things, obviously gold will be would be a total hedge against such uncertainties, and that's why I think the firmness in the price is also going forward as such. So that way.
Okay. Mr. Irani, where do you find valuations still unattractive? What are the spaces that the market has still not touched, whether it's historical look at FMCG, they haven't done anything for 4-5 years, but P's are still in 45, 50, 60 range. Where do you think is still pain that the market has held back, but it will give it?
I think one is obviously the one which you stated, which is FMCG stocks, still at 50, 60 kind of P's for growth rates of late single digits to mid single digits kind of growth rates in earnings I'm talking about. If you're talking about consumption, with this kind of booster that the government has given, it won't be the staples which will perform. It will be mainly the discretionary which should perform, and that's why we don't see much upside in the FMCG part of the offerings. Secondly is autos. I think in the four-wheeler space, the rally was overdone, and that's why you're seeing such a shed happening in that rally as such. Frankly, I mean, if one were to hear what Trump has to say about India, it's always about autos. I mean, the way we apply our duties and protect our auto companies. Obviously, there's a limited amount of play that can come into India, but the fact is that the growth nowadays is in the SUV part of the business where a lot of competition can come in if you reduce duties sharply out there. So I think that is another area which is fairly looking overpriced. Paints, we've always been negative, and we still believe that even though they've not done much, most of the companies, but we believe that they're looking very stretched out there. IT already shared with you, I think, the fact that even the pre-COVID valuations, most of the companies are quoting at double those. That also puts us off a bit on IT, and the fact, as I said, AI is going to be a big disruptor going forward. So these are the few segments that we're not too at all comfortable with. And I'll leave it here probably.
Okay. And Pharma, of course, has been a new addition in your portfolio. An MNC stock starting with the alphabet G is what you prefer. How are Indian pharma companies spaced given what Mr. Trump is up to? Do you think, given the problems that the US healthcare space has, maybe pharma will escape his attention, or even there, do you see a lot of pain in the offing?
Not really. I don't think Pharma going to escape his attention, because as they said that they're going to go line by line on 2nd April, item by item. So obviously
Yes.
they're targeting Pharma in a big way. Though we supply cheap, I mean, as in the generics that we supply out there are cheaper than their own generics. But I'm sure he can see the margins of these generic plays, and I think that's what he's trying to target as such. That how can they make so much money off me, even though we are cheaper than those guys. But the fact is that that again brings in a lot of uncertainty, and that's why we are trying to avoid getting into pharma, at least the US facing pharma. And the play that we have is mainly a domestic play that we are going with.
Uh, uh, Mr. Irani, this is your third decade in the market, and half of it is also, I mean, you've spent more than 33 years in the market. Are we back to the 90s era when domestic markets was what we were looking at, focus on domestic growth, focus on where you have lesser and lesser global linkages, and maybe it's a secluded or maybe a top heavy kind of a market where 20-30 stocks will work and the rest 3,500 will lie sideways? How do you see the next 18 months?
So, Sharinder, I wish it was that way, but the fact is, since the 90s, things have changed a lot, right? I mean, we felt that way in 2008 also, that India is very insulated, it can't be affected by the GFC, and you saw what India did. I mean, it fell more than the world did as such. So I don't think that's going to work anymore. You have to go with the world, and it's such a tight-end economy. I mean, the world economy per se. You got to be that way, and the fact is that even though we can always say that we have enough money sloshing around now than what we had earlier in terms of the retail investors, but I think one has to at least respect the fact that if the world is not doing well, we won't be doing well either. And yeah, so I'll.
So you communicate very well with your existing investors in the FlexiCap fund and the two other funds that the AMC has. What are you telling them? Of course, continuing SIP is perhaps the first point that you are telling them. Is that true?
Yeah, actually, we've been telling that only that, look, this is somewhere near the bottom, as I said, that obviously things will change once we realize what's going to happen. But the fact is, when you're in a SIP kind of investment phase, systematic investment plans I'm talking about, investment phase, then it is a different ball game altogether. These are the levels where you want to average out. These are the levels where you need to, where the real wealth creation will be created. Otherwise, if you keep averaging in the top and panic once you're closer to the bottom, there's no way your wealth creation will happen. And one more thing I want to add out here, Shalinder, you said about those, sorry, I didn't touch upon that point, about those 30 odd stocks doing well. I think going forward, at least for the next couple of years, the market will be a stock pickers market.
Okay.
And that is why we have to be very selective in our investment outlook as such. And that's why I said that I won't, though I can tell you sectors, but I won't paint them with the same brush. I mean, there'll be pockets within that same sector which will suffer and the ones which will gain. And I think that's where the stock picker comes in. And fortunately for us, we have a Samir who's been around for ages and who's been doing that on a regular basis. So let's see how that goes.
Okay, now from the same argument, if you go back and look at all the 5, 7, 8, 10 stocks that you've added, they are large caps.
Yes, very true. And that's why I said that the comfort today is in large caps. Mid caps, again, we have, by the way, we raised a mid cap fund. And today we'll be reporting the first NAV as such. We haven't been in a rush to invest in that fund also. The fact is that, again, we like quite a few stocks within the mid cap space. But at least right now we have time on our side. We have the leisure of waiting out. Maybe we'll be wrong in waiting out. Maybe the markets will go up from here. Who knows? I mean, nobody knows. But the fact is that once you're secure in your outlook, once we are clear about what's going to happen, probably that is when we'll be looking at the mid cap and the small cap part of the market also. And as I've been telling all my investors, I mean, in the mid cap also fund, it's going to be a pure mid and small cap kind of a play. It's not going to be a pure mid cap play. There's a leeway which is allowed beyond less than 35% into other caps also. So we'll probably keep that in the small cap space. But as I said, that we'll do only when we are very sure about where the market is headed, and then when we'll be starting to invest. But today, I think large caps provide that comfort level in terms of valuations. If one looks at it, I think overall, if you look at the Nifty 50 valuations, they're back to the 19-year averages, which is more of a comfort than anything else.
So, are fund managers looking at each other and thinking, जब ये खरीदना शुरू करेगा तो मैं भी कर लूँगा? I mean, I'm sure all of you meet at Nariman Point, you know, in one of those lovely clubs and decide कि वे बहुत हो गया, अब तो इतना सारा कैश पड़ा हुआ है, इसको डिप्लॉय करते हैं, क्या करें बैठे बैठे? Is there, by the way, a SEBI restriction on the amount of cash that you can hold and for how long?
No, there is no restriction on the cash that you can raise in the fund. But yeah, if you raise a new fund, that is the restriction which is there. I mean, as in you got to start deploying the money. I think from 1st April it kicks in a big way, which is 30 days. So that way. But otherwise, no, we don't meet. None of the fund managers meet. If we meet, the market is the last thing that we talk about, because we're tired of talking of the market and seeing it on a daily basis. So we talk about friends and family. So that's about it.
Then the market has bottomed. When fund managers talk about friends and family and getting back to lives, then the market has bottomed definitely.
No, as I said, that I think we're somewhere close to the bottom. So that's where it is.
My thumb rule is that if I get an invite for dinner in the middle of the week, then there is a crisis in the portfolio. My friend hasn't told his better half about the losses that he's made, and he wants me to break the bad news. That hasn't happened. So many thumb rules in the market. Okay. A couple of questions on what investors, the people who've come in now, should do in terms of tweaking their expectations, and of course the deployment of fresh capital into assets. If you could just help us understand how should expectations be tailored from now on, and if fresh money has to be deployed, how would they come in? Large caps, mid caps, small caps, what would you suggest?
So actually our feel is that probably for the next couple of quarters, one may see the markets going into a time correction. Rather, it'll be a flatline kind of a market with obviously pockets which will do well and pockets which will do badly as such. So that way, and that's why I said the stock pickers is the one which will come into play here. Stock picking will come into play here. And in terms of the caps, I think obviously the first preference today is large caps. But as and when things stabilize, and as I said that we've been not carried away by the large cap thing, but we're looking at opportunities. And as and when we see them, probably it'll be the mid and small, which will be the real one which will turn around the returns for all the investors. So that way. And one more thing that I want to add out here, which you didn't ask about, was is that if an investor is looking to come in a fresh way in the market today, I think you should start nibbling at the markets rather than deploying the whole money. Probably stagger it across a couple of quarters, if you will.
Okay. With that somber note, ladies and gentlemen, we'll thank Mr. Irani, and that smile is back. As you can make out, he's wearing a fabulous set of glasses. He was on a recent trip to France where he bought this lovely frame, and I promised that when I meet him in person, this is what I'm taking from him.
That was just between you and me, actually, sir.
Thank you so much, Mr. Irani. It is always such a pleasure to listen to you, and more importantly, look at your smile in these painful times. Thank you for your time and your information.
Thank you, Shailendra. Always a pleasure to be on your show.
Okay. With that, ladies and gentlemen, we draw to a close. Mr. Irani has done a lot of hard work in the last 20-25 days. He's exited IT completely, and 20% of his AUM, which was roughly 3,400 crores, was cash. 50% of that cash has been deployed. It has gone into private banks, HDFC, ICICI, Kotak. It has gone into increasing stakes in NBFCs such as Chola, Shriram Finance and Bajaj Finance. He's got into Bajaj Auto and cut out 2 platform stocks, which is PB Fintech and Swiggy. So that's the state of portfolio as of now. He prefers large caps over mid caps, and of course advises you to slowly but certainly start investing into the market. His best quote was, "Our heart tells us that we are somewhere near at the bottom, but our head tells us to be cautious." With that, we will bring today's show to a close, ladies and gentlemen, but stay tuned to Business Today Television. There's a lot that's happening on the other side of the break.
உலக அளவிலான வெற்றியாளர்கள் மட்டுமின்றி தேசிய
The Tamil Nadu government doubles down on 2-language policy.
கண்காட்சிகள்
State Finance Minister Thangam Thinarasu presented the last full budget of the DMK government before the assembly elections next year. Declared his government will bear the cost if the Narendra Modi government blocks 2,100